Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Been gone for a few weeks, a couple of different vacations and what have you. Really glad to be back today. This is a show that we do as a live stream to try to help people improve their retirement, especially in the area of finance. We like to talk about, what's going on with the markets and how to manage your money. What type of planning should be done both before and during, your retirement. And then, of course, tax strategies that might, help us save some money and whatnot too. So we do this predominantly through answering questions. And so you can send in questions now if you would like. Send them in during the week even, so we get a little chance to look at them. But you can use the email address, asktom@talkmoneywithtom.com, or you can actually just put it into chat here on the YouTube window, so to speak, channel. And so we want to be able to answer questions. Go ahead and send those in. And then, obviously the channel itself is, I think, a good educational source. You can subscribe to the channel. You can hit the bell button to get notified when we put new content out. And then, of course, if you just want to meet with us and talk to us, you can do that also. There's a book appointment button on our website for our company. You can see the link here on the channel. And up on the corner, the button looks just like this. You can hit that and schedule a 30-minute time with Ethan and I, and just ask some personal questions. 30 minutes, let's say, here in the office, on the phone, video. We're easy as far as that goes. So, anyway, looking forward to today's show. We've already got some good questions in place. We've had some good questions that came up a few times with client strategy sessions this week, over the last few weeks anyway, and we'll cover some of those also. So. I do always like to start off the show with a rundown of kind of what we saw happening this week in the market, and there's a lot going on actually. So let's talk about that. All right. So first of all, this is kind of a longer term chart here. We got weekly data, so it's kind of smoothed out a little bit. You can see, the big pandemic drop that happened, big run up after that, and inflation was high. We dropped 28%. So we bottomed out here, on the run that we're on now, October 13th of 2022. All right. So bull markets are 3 to 5 years, depending on what time frame you're looking back, right? So we're 1 3/4 years into this, more or less, something along that. So there's some room to run. I do believe that I think the shortest bull market was like a year and a half or something like that, or shorter, maybe not shortest, but I think we have room to run here. However, if you look at the amazing amount of return that has come from, October 27th of last year to basically today, we've had only one interruption, 5% drop in April this year. And it looks like we're heading for another interruption as we speak, because this week, of course, we've had a 1.4% drop, followed by a 0.8% drop, and we were around 0.8% when the show started, drop for today also. And so the first half of July is the best half a month historically, going all the way back to 1928 and using that data. And the second half is much more, of a mundane, average rate of return for
pretty flat period.
Yeah, and matter of fact, the data that they looked at going back to 1928, they mentioned in that Bloomberg article that the softness started on the 17th. Okay, so that 17th was, the 1.4% down day, and so we've been coming down every day since that point in time, and we have a ways to go before we're going to see a reversal trend. But what we are seeing right now, I think, is just, the first half of the month, it was 11 trading days. We were up on 10 of them, right? Mm-hmm. So you're not going to hold those kind of gains that often. And we are now heading into a softer time of the year, right? So there's some things going on as far as that goes. Fundamentally, not much has changed, right? There was some talk that kind of kicked off the downturn on the 17th. From both sides, actually. On one side, the White House came out and said they were going to crack down more on sales of chips to China.
Yeah, basically, anything with U.S. technology could be considered put under restriction.
Yeah, and then that same day, actually, Trump talked about whether or not they would support Taiwan if China invaded, and he was waffling on it a little bit, and saying that they might have to pay for their own security type of thing, and whatnot. So both of those pieces that come together start this downturn, but I still think you can attach news to almost anything that's going on, right? It could have been still going up even with those comments, and nobody would have said anything about those comments. I think this is much more so a situation where we stretch the rubber band so much to the upside, and we're going to get some pullback. I look at these things as positives. All downturns are positives until they actually go far enough to change the primary direction. Because if you look at last year, we had a 10% drop from July 31st to October 27th, and yet we still ended up with a 25% gain for the year. Sometimes you need to come down to stimulate that buying, right? And so, people aren't interested at that higher price at this time, and leaves just sellers, and you start to come down. So if you look at the primary trend, one of the things, we look at lots of things, and I try to keep this on the show fairly simple. There is more behind the scenes that happens, but this is a good one to watch, and everybody can do this. You look at the lows on the way up, right? And so what? There's 5 arrows there. Every low is higher than the last one. So that's still maintaining the primary trend. Now, in order to make the primary trend reverse to downside, right, you have to kind of get below the last low, which is that last arrow there. So basically, draw a little line there. If the market falls below that, we are now in a primary downtrend. If you look at the numbers behind this, it is 49.67 is that low point, and we got to 56.67, exactly 700 points was the closing high so far. So it's a 12% drop, right? I'd be a little surprised to see a 12% drop here. There seems to be still enough power in this momentum upward. Anything can happen. Weird things happen all the time. But that's what we'll be watching for. So until you get to that point where you're cracking through that low, this downturn is just a secondary minor move to the downside, right? Those are good things in a hot market, because again, if we want to get to the next all-time high close and really make it run again, might take till November for the election to really see that. But nonetheless, that consolidation period and that drop that comes down will be, what kind of stimulates the buying ultimately. And then one of the other things is that you get some support. So one of the problems we have since October, we basically haven't spent any time at any price for very long. There's some support for that retracement that happened in April, right, and back up in May. And so, we could bounce off of that. I wouldn't be surprised. But the problem with going up so fast like we have so far, just recently, is there's no support. We didn't spend any time there. So I wouldn't be surprised to see it come down to at least the top of that April move.
So like that 5,200 area.
Yes. Yeah, exactly. That wouldn't surprise me at all. Matter of fact, I'd be surprised if it didn't get there. Just because, again, we're in a selling mode now. There's enough momentum happening that, you'll get down to some price that hopefully people want. One of the other things we look at, now this is daily data, so you can see it's a little bit more, jagged, but the blue line there is the 200-day moving average. So, every point on that line looks at the past 200 days and averages it out and puts the point. And the yellow or gold line there is a 50-day moving average. And so, you're looking for that crossover. They call it the death cross for a reason, where the 50 is coming down. You can look back there at the beginning of 2022, and that was the last death cross we had. The other way where it comes up under it was February of last year. That's called the golden cross, right? So they're really far apart right now.
Yeah.
And you can see last year, it dipped down, it got closer, with that 10% drop, but it never crossed through either. So if we look at last year's downturn, we never had a primary direction change based on the lows, because we never got to a new low, a lower low, and then we never had a death cross either. So both of those. So those are, we're going to have some roughness here, in my opinion. We're heading for a seasonal, and I'll show you. This is our primary trends piece. This is kind of interesting, right? We basically put a column on there when something changes. So on the 18th, yesterday, the hourly piece changed to red, which just means that the primary direction, if you look at the hourly component data. So in other words, you can look at the market by hour, by day, by week, by month, right? Now you can get by minute and all kinds of things, but by hour, we've actually changed direction. So for us, that just means new money coming in. We're waiting. We're holding on to it because we'd like to see that reverse before we start to throw that new money in case this turns into a bigger downturn. So there's always that possibility. So we'll wait for a little while. If we look at kind of the breadth of all of these other ETFs, that represent different segments of the market and what have you, all still the same as they were on June 3rd, which is all green except for transportation, right? Which is still not. It made a run at trying to get to a new high to turn that back to green, but it hasn't happened. So anyway, that's what's going on. But on a seasonal basis, we shared this chart the last show. I apologize because some of the numbers are pretty small. But what this is just showing is on average, what percentage of the time was the month positive, right? And so July, 75% positive. And then there's a small number down by the axis that says 2.4%.
Yeah, so we averaged 2.4% return per the month.
Right. And so, but if you look at, here's August, September, October, all of them have a 60%, chance of having a positive month, or historically anyway. But the returns are, 0.1% for August, so basically nothing on average. Negative 0.6 in September.
Yeah, September's only negative month out there.
Yeah, that's right.
Or no, actually June is.
June has a small negative too, but it's the weakest month. A lot of people talk about October, clients, because they remember, the bigger crashes like the 87 crash and stuff. But on average, October is actually, out of the 3 months, is best. It's got a 1% average return. So we have this seasonal situation. We're also in a presidential election year. And so in my experience, presidential election years, you get at least a lot of volatility in September and October, and usually volume kind of dies down some. I think the markets are somewhat concerned about who's going to win, but more concerned about unknowns than anything else. So, once the election is over, you get November, which is a great month. It's 80% time. It's up, and it's up 2.5%. That's the highest month. So November is the best. So, and that's true of elections also. You'll notice it doesn't matter who wins and what happens. The market has gone up for a really long time, as far as I can remember, in November after a presidential election's over. So we kind of have the seasonal aspect of what's coming here. We've already had a big run up. We've got a falling market for the last 3 days. I think we continue to have some volatility. I don't think we'll change primary direction. I don't think we'll get that full 12% down. That would be my guess anyway, even with the election coming, because there is a lot of things going on. Now, there is one part of this that could move this the other way to make it a stronger, September, for example, and that is this rate cut. And so right now, the market is expecting almost 100% chance of a rate cut in September. Of course, if it doesn't happen, that expectation would be, detrimental. And so, yeah, we have seasonality. Yes, we have, presidential election year seasonality combined together to probably make things soft. Could be offset some by, the decrease in rates. I have to wonder how much of that's already baked in, to the situation. Do we get a big pop? I mean, we've been talking about cutting rates for a long time. The last rate increase was in July, right? Yeah. So a year. And so I think it's a very, interesting market to be involved with. But it's, the momentum is already there. If you look at the numbers, I mean, if you look at the last times that we've had a 15% or close to 15% return in the first half, we've averaged 10% in the second half, right? I think we're gonna get that. I wouldn't be surprised. However, just like last year, you can still have a pretty good sized downturn in the middle of that. And some ways, again, I think you need to have that kind of downturn. If you don't, you're going to end up with a market that is so stretched out and is so thin, and earnings are, PE ratios are really out of whack. That's how you can get a bigger downturn, turn into a bear market, which is considered 20% drop or more, right? I like these little, let's take some steam off here. We've had a great run even since the, I think 19th of April was the low point for that little April run to the downside. And so we've been basically going up almost every day, since April. So, hey, let's have a little steam off, not enough to maybe change direction, but 5%, 10% range, whatever it might be. Let's waffle around for a while, build a base, because I think that's important. And then if you could design it as an ideal, you would jump out of that base and now you have support below that, and you've got a healthier market run that happens. And so, the stock market is a representation of human emotion. It doesn't go in a straight line because of that. It generally goes to the extremes to a large degree. And so you're going to stretch it out too far, and then everybody realizes that, and then it falls back down, and that's how it works. And understanding it and dealing with it and being patient with it is how you get paid more, right? Because you go to the bank, you put the money in CD, pays pretty decent right now, but you're not making the kind of money that we're making in the stock market over a long period of time. And so you have to be able to kind of understand the market. That's what this show is about. It's why I put out the video every single day, just trying to explain kind of what's happening to the market itself. So anyway, that's our summary for this week. Really glad that you could join us. Looking forward to doing it again next week. Let's start with our first question.
So, do I need to take RMDs on my, actually, where do you expect the market to go over the next couple months before the election?
Oh, where do you expect the market to go? Okay. I would look at it historically, right? I mean, there's a couple pieces here. Number one, there's a seasonality that happens. September and October aren't the strongest months. September is the biggest negative average month for return. And so that factors in. So I think that shows some softness. I remember in 2020, and that was a great year, a really good year. But September, we dropped about 9%, and I think in October, and we bounced back. And then in October, we dropped, I think, right around 10%, And so I wouldn't be surprised to see stuff like that happening, because there is a lot of unknowns that are going to be coming in terms of the political situation, and a lot of upheavals that'll happen.
So you expect some decent amount of volatility over the next couple of months?
Yeah, I wouldn't be surprised at all. And now, again, November is a great month, so kind of hang in there.
Yeah.
People kind of know that we might see a good run out of that. We do have this other catalyst, though, which is this rate cut that is now looking likely. The market this year has been so wrong about rate cuts, right? And we're expecting 6 originally, expecting the first one in March. I remember you and I talking about that, and we're like,
data's not there yet.
Yeah, I didn't see it. I see September now. I could see that happening. I mean, one of the main things is the Federal Reserve has a mandate, a dual mandate. One is what they call full employment, and second is 2% or less, but not too much less, on core PCE inflation factor, right? And so we're at 2.57% on PCE. So they're already talking. Jay Powell's talking about, hey, we're not going to wait till it gets to 2 because it might slide down too far past that. So they're there. That's the number. That's the key issue. And then their unemployment for them, full employment means less 4% or less unemployment.
Yeah, I think their wiggle room is 4.5%, 4.5%. So they're allowing themselves to go up a little bit higher to allow inflation to come back down.
Probably going to happen because the economy slows down enough as they continue to keep these rates up. But it is above 4 now, so that's kind of significant too. And so that could be the offsetting factor. Personally, I don't think anything really changes for us in terms of big type of moves. There might be some rotational things that happen. What happens with semiconductors? Because SOX was down 7% a couple days ago, up a little bit yesterday. Today, before the show started, it was down almost 2.9%. And so SOX is the semiconductor index.
Could there be a rotation into small cap that's been running this week too?
Yeah, the small cap rotation has been very interesting to see where that plays out. So anyway, I would say volatility would be expected, but maybe nothing big in terms of downturn. There'll be some run-ups that happen too. Last summer we were down 10%, but we had 2 fairly good-sized run-ups in that. Kind of came down and jumps up, and then never gets a new high, but comes back up. All the highs are lower, which is one of the things you look for. And then we finally broke through that in late April, early May. So I would think that we'll see some things like that happening here too, as far as that goes. So it's a good question.
So do I need to take RMDs on my inherited IRAs?
All right, so RMDs is a required minimum distribution. And so normally when you have an IRA, 401k, or these different types of retirement plans, once you turn 73, you have to start taking money out. There's a table, it's based on your age. You take the number that's in the table and you divide it into the value of your IRA or 401k or whatever it is, at the end of last year, and you have to take money out. There's all kinds of exceptions. The 401k, if you're still working, you can avoid the RMDs. There's all kinds of weird things. But just to keep it simple now, what happens if you inherit an IRA? Okay, and so there's a chart that we got this from another advisor, another financial planner. I know it's kind of busy, but if you're really interested in this, you could kind of freeze the frame here and zoom in some, because this is a pretty good chart, actually. I think I did a good job
and
with
now
it.
the IRS finally ruled yesterday and finalized the rules. So now everything's kind of official, so you know what you have to do.
Yeah, because they put in a rule that for certain people that inherit an IRA, they have to take it out in 10 years. It used to be you could take it out over your lifetime.
You really only had lifetime stretch, essentially.
Right. Yeah, exactly. But now, they're in exchange for not making people start their requirement minimum distributions at 70 and a half, which is where it was for a really long time. They moved that to 73, but then they kind of hosed the beneficiaries and making them take it out in 10 years. Now, if it's a small IRA or inheritance or something, it's not going to be as big a deal, but there is trillions of dollars in 401ks and different things that are out there that are going to be passed through. And so at first, they didn't say you had to take anything else out until year 10.
Yeah, basically people assume that they just, if they want to, they could hold all the money and take a lump sum at year 10 and just deal with the taxes for that 1 year.
Right, exactly. So if we look at this chart, you're either a designated beneficiary or non-designated. Non-designated would be like charities and estates and those types of things. I'll ignore that portion for a minute. Amongst the designated beneficiaries, there's two divisions. One is what they call eligible. And it just means that if you're eligible, you can kind of take over that IRA as if it was yours and deal with the same things that you were doing before.
It's pretty selective in who can be in that kind of eligible category.
Right.
Surviving spouses, you have to be within 10 years of 10 years younger.
Right.
If you're disabled or chronically ill or minor children.
Yeah, exactly. So those rules are kind of similar. That hasn't changed that much. It's the other non-eligible. So your kids are usually obviously farther than 10 years differential from you, so they have to take that over. And so here's what the IRS basically ruled on out of all of this, which is just before it wasn't clear if you had to take out anything until the 10th year. Now they've said if the person that you are getting the money from, right, was taking their required minimum distribution,
or had to take it,
the year that they had to take it, whether they did or not, right? Because it could be that first year. Then you have to start taking a required minimum distribution during that 10-year period. Now it's going to be less because the table is based on age and life expectancy. So if you're 40 years old when you inherit it, you're going to take out less than your 80-year-old.
Yeah, so it's based on the beneficiary's lifetime, not the actual person who passed away.
Yeah, so if they were taking a required minimum distribution, you have to take a required minimum distribution as a minimum during that 10-year period, and you still have to take it out at the end of the 10-year period.
Yep.
So we've been ahead of this for a long time, actually, because again, if it's a big account, you really got to think about it, because it could be a huge deal. You got $1 million inheritance, an IRA or something. You don't want that thing to turn into $2 million and then have to take it all out at the 10th year. Mm-hmm. Things double every 10 years at 7%, for example, right? So it's quite possible. What we do is we do, basically divide by 10 for the first year, take that out, divide by 9, divide by 8. And so we basically are taking 1/10 of it out each year. That's what we recommend. But now you have to at least take this required minimum distribution.
Yeah, and that starts next year. So January,
that's right.
January 1st, 2025. So,
yep.
And the nice thing about it is the IRS is not making you do any retroactive RMDs.
Yeah.
So basically, if you didn't take RMDs, you're okay. Now you have to start taking those RMDs.
So then there's the other side, Would you inherit an IRA or 401k or whatever, a retirement plan, and the person that you inherited from had not been required to start their required minimum distribution, then you don't have to do one either.
Yeah. And so
You still have to take it out in 10 years.
you still have to take it out in 10 years. But the way to understand that, a lot of the people that inherit IRAs probably are having someone who's taken RMD. But if they had a Roth account,
Yes.
it would fall under this rule too, because on a Roth account, you're never required to take RMDs.
Yeah.
And so you'd fall into that 10-year rule. And so our recommendation for Roth accounts is always to let them grow for the 10 years that you
Yeah,
have.
that's a big one. So no required minimum distribution for anybody for a Roth IRA. And so if you inherit a Roth IRA, you don't have a required minimum distribution either until the 10th year. And so because it's growing tax-free, you don't have to worry about if it goes from $1 million to $2 million, whoopee,
Yeah.
I get $2 million out of that thing and I got $1 million worth of growth that was tax-free. And Roths are so powerful and so unique, and one of the only ways that you can get stock market rates of return tax-free. You want to leave that thing alone if you can. Obviously, if you have to, you have to. But if you can, leave it alone and take it out in the 10th year because there's no tax consequence. It's a great thing to inherit, actually. And so anyway, those are the rules around it. Again, the only real change is that they're requiring a minimum distribution on inherited taxable retirement account. If the person that you inherited it from was already doing a required minimum distribution.
Yeah, and
So
this only
bottom line.
applies to
Yeah.
people that passed after 2020, after a secure
Yeah,
act.
that's right. That's right. There was a. And that's true of all these tax laws. I mean, look at this thing.
It's too confusing.
It's a mess. Yeah, it really is. They took something. It's always like this. I swear, it's crazy. But it's what makes the world go around. It keeps us all in business, I suppose. But it's an interesting question. All right.
So what are options and when should I be using them?
Okay. So options in terms of in terms of what I'm investing, options. Got a visual on this too.
Yeah, so an option is basically you're buying a contract. So you're not actually buying the underlying security or stock or whatever. You're buying a contract to have a right to purchase this at a certain or sell at a certain price, and the contract has an expiration date.
Yeah. So I can say, hey, I want the right to be able to buy Apple at $5 above where it is now, right?
Yeah.
So, which sounds kind of weird. Who would want that right? Why not just buy it now? Because there's a lot of strategies and what have you too, and you can sell calls and buy calls, but in a generic sense, it's just a contract to be able to buy that. So theoretically, if the stock goes up, let's say $10 more than it is now, and I got a contract to buy it at $5, I can execute that contract and make some money on it, right?
Yeah, and so the idea is that it's kind of that price differential.
Yeah.
And so the idea with options is you kind of get leverage.
Yeah.
You're required to put, with any contract, I believe it's 100 shares.
Yep. Yep.
And so you can multiply it because an option is much cheaper than buying 100 shares of
Yeah.
the stock.
Yeah, I'd say that the main uses for them are, somebody trying to cover risk in some form or fashion. Mark Cuban's kind of a famous thing. He sold his company to Yahoo, and they gave him stock as part of that purchase. And his broker basically wanted to protect Yahoo stock from dropping. They basically put some options against that stock that would go up, right?
Mm-hmm.
If the price of Yahoo went down, and he made like billions of dollars on that option trade because Yahoo crashed essentially. So,
that .com
so
bubble.
yeah, you can see them. They're used in that regards as sort of a portfolio risk management tool. But probably the most common thing we're seeing and reading about now is people trading options instead, because like Ethan said, if I want to trade, NVIDIA and I want to buy 100 shares, it's going to cost what 10,000, 11, 12,000, whatever it is at now, right? Versus I can go and have some control over 100 shares by putting maybe even just $1,000 or
Yeah.
what have you into an option, that could turn into 2,000. The problem with options, and this problem with options trading, is yeah, you can magnify your gains, but it's pretty easy to lose the whole thing because it expires.
Yeah.
It has a timeline versus, hey, I buy 100 shares of Nvidia. The chances of it going to zero are pretty slow, pretty
Yeah,
small.
the chance
Right.
of an option going to zero is much higher than your stock going to zero.
Yeah, I mean, well, it actually is guaranteed to go to zero
Yeah.
in a way, right? Because it's going to expire. So that's a hard thing to deal with. And so they have all kinds of different expiration dates out there and what have you. You can buy, one that's going to expire, in a couple of hours even.
Yeah, and there's much more complicated things you can do with options, but
Right.
usually for the average person, uh, options are, you don't need it really, and it's cool to know about, but you
Right.
don't use it very often.
Yeah, we don't use it in our practice, for this type of purpose, and but it became a really big thing within the kind of trading community in 2020. You know, and you can do well with it if you're got the right luck on your side and the right knowledge and what have you. But it is a different game. All right.
If I lose confidence in a stock, should I start to look for an exit?
If I lose confidence in a stock, yeah, I used to call it when the story changes. Because, a lot of people, oh, should I keep this or not keep this? Because the stock's coming down maybe a little bit and they're wondering, and it's like, well, has the story changed? If you look back at GE, great company, one of the original Dow components, the story started to change. If you looked, earnings started to disintegrate. They had high flying units that started to really pull down the company, their financial unit, and what have you. And so, the story changed, and that stock ended up dropping 90% before it finally found its footing and come back around. So, and by the time you really get into the story, the stock might already be down, 10 or 15 or 20%, but that's probably a good time to take a look at lightening up your load in that particular stock so you don't suffer through the 90%
Yeah,
possibility.
and you could look to reduce your position. You don't have to sell out completely.
Mhm.
So if you have a large enough position, maybe you start to kind of like a reverse dollar cost averaging. So you just sell a little portion every month, just kind of lower your position over time.
Yeah, it does matter whether that position that you're talking about is in a situation that you'll have to pay tax if you sell it.
Hmm.
Do you have a big gain? Do you not have a big gain? Or is it in a retirement plan where there isn't any gain anyway? It could be in a Roth. So if there's a big gain and it is in a taxable account, then changes the calculus a little bit. People tend to ride through more of those waves in those types of accounts just because of the tax. Um, However, the tax isn't that high, and it's pretty easy to lose, more than the tax that you would have paid. So, for example, if I sell $100,000 worth of a stock, and let's say I had a $50,000 cost basis, I have taxes on the other 50,000.
Hmm.
But as long as my joint income is below, what is it, 500 and some odd $1,000,
Yeah.
I am at the 15% bracket
Hmm.
on that 50,000. That's pretty good. I'm telling you, historically, capital gains rates are really good right now, and they might not always be this low. So I'm not too worried about paying taxes because once I've paid the tax on that whole 100,000, or the extra 50, I don't have to pay it again. Now I've got a cost basis. I can put that somewhere else.
Hmm.
And then, of course, your state will have tax. Here in California, it's pretty easy to get into the 9% bracket,
Yeah,
pretty
usually
quick.
9% is where majority of the people end up.
Yeah, but you could be in a state that doesn't have a state tax and what have you too. But it is something to factor in to, hey, if you lose confidence, how much confidence have you lost and how much are you willing to pay if you have to in terms of
Yeah,
taxes?
and so it may be just you downsize that position. You don't
Yeah.
actually have to, maybe you're waffling a little bit. So let's maybe drop the position by half or do
Yeah,
something like that.
right.
You still keep some, but then you kind of re-diversify out.
Yeah, that's a good question.
Should I ever consider closing accounts with tax consequences to just simplify the amount of accounts I have in my financial life?
So, yeah, you got a bunch of accounts, or maybe not, maybe more than you want, and you're just trying to make things simpler. And so, as you close accounts, something triggers a taxable event, right?
Yeah.
Ooh, it really depends on the amount, right? I mean, $1,000 is one thing, taxable income. 500,000. Yeah, there's a dollar amount there that's too high,
Yeah.
even for trying to simplify your life. So, if there's there could be zero cost to do it, right?
Yeah. So you should look
Tax
at
wise.
if you have accounts that are the similar. Say you have two trust accounts at two different brokers and you want to simplify. You can look to see if you can do a like-to-like transfer. That
Yeah.
way you have no taxable
Right.
event.
Right.
But let's say you have an annuity and you also have a trust account. They're both named in the name of the trust, but to move the annuity into that other trust account, you'd have to surrender
Right.
the annuity. So that would be a taxable event. So not all simplification causes taxable events,
Right.
but you should evaluate each one by itself.
Yeah, I had a story from a client from years ago who was, very thrifty. Was a really good investor, actually. She did really well. But one of the things that she really liked was back in the day, you could open up accounts at the bank, and they were giving away things to open up an account, a toaster or whatever. And so she had like I don't know, maybe 30 passbooks that she showed me one time for all these accounts she'd opened up with kind of the minimum amount of money to get all these things. And so, I mean, that's going to be a bear for somebody to deal with as far as that goes. So it's nice to kind of simplify that. And, I've also seen situations where a guy that worked for a oil company, he got a little bit of a royalty from every drilling well that his company did, and he might have had like 120 of them, and it was great. It was good income. It was kind of nice, but he ended up selling that whole thing after he retired to somebody at the company, just because it was going to be a nightmare for whoever got that as a beneficiary to go through and re-register. 'Cause every single one was sort of like a different security. So sometimes there are things that are just really worth doing, just from a simplification standpoint for everybody, not just for you, but for your estate settlement also. Yeah, not everything has taxable consequences. Make sure you know which ones do, and try to figure out whether it's worth it to you or not, or how you might be able to even avoid that tax if possible. Yeah. Good question.
So, what is the point of keeping a cash position in a portfolio, a managed portfolio?
Yeah, I mean, if you look at any of the target date funds that you've got, or a mutual fund, or what have you, almost every managed type account has some type of cash position. Usually, it's pretty small, kind of in a 2% or less range, as far as that goes. And so, it's usually for the same reasons. First of all, cash, it can be quite higher in some situations. I mean, this week, cash is the best asset we have, with the market coming down, at least from the stock market standpoint. And so it can be part of an asset allocation. And sometimes, we'll actually up the amount of cash that we have quite a bit. But mostly it's for trading purposes, right? And so you see like the, target date fund, Vanguard or whatever, got a 2% cash position. Because when you're kind of buying and selling, you can't always buy full share, right?
Yeah.
Depends on the situation and what have you. But you can buy the next. So let's say the share price is $500, and I only have $400 left in my cash account after purchasing let's say 9 shares. I can't purchase a 10 share. I'm going to end up with that $400 left in my cash account because I don't have enough money to buy. So that's why there's often a situation with some money in the money market. If there's fees to be paid, like for us, that comes out of the money market. So that's a piece. We also have cash in our accounts for our clients that are taking money out, every month too. So we'll try to do 3 to 6 months worth of withdrawals sitting there. When that runs down, we'll replenish it. So we're really only doing transactions, 2-3 times a year that way, and kind of reducing the amount of transactions that happen. So anyway, those are some of the main reasons that I can think of for why there's cash in an account. All right, I think we have time for one more.
What is an assumable mortgage?
Oh, yeah, this is kind of interesting. It's becoming more of a talking point now, right? So you want to buy a house, and current mortgage rates are, let's say, 7%. What if the person that has the house has a 3% mortgage? Wouldn't it be nice to take that mortgage over and keep that 3%. And so that's one of the, I would think that's a really interesting area. It's probably not being asked enough, whether it is assumable or not. So it's a good information to know. If you're going to buy that house and they have that mortgage, trying to find out from the seller whether that's an assumable mortgage that you might be able to qualify for. You still have to qualify for it.
So yeah, you have to do additional paperwork to basically with the current lender to qualify, but then you also have to be able to buy out the person's equity.
Yeah, that's right.
And so if they've had this house for 30 or 10 years and they have 10 years worth of equity, you're gonna have trouble buying out that equity.
Yeah,
So
yeah.
you have to have the cash on the side to actually do that or figure out a way to generate the cash.
Yeah, you might be able to get some of it from a equity credit line or second mortgage on the house. Of course, there's going to be much higher cost, in terms of the interest rates and what have you. But you're exactly right. Ideally, the mortgage is most of the value of the home, 80%. So there's not as much, that you have to buy out or what have you. But it is still pretty fascinating.
Yeah, you're probably trying to look for someone that's recently purchased into
Yeah,
the house
yeah.
that got locked in at these 3% rates
Yeah.
a couple of years ago,
Right.
and so they haven't had time to build that much equity. And because housing prices over the last couple of years have kind of slowed down in their growth, so you're still able to afford their equity.
Yeah, yeah. It's an interesting piece. I think that not everybody is aware that that's even possible. So
Yeah, it's something to ask when you're buying from an existing owner. Is the mortgage assumable, and if so, you could try and do your due diligence on that.
yeah, yeah. All right. Well, that's a wrap for our show today. I want to thank everybody so much for coming. Remember that you can send in questions during the week. We'd be happy to get ready for them and do some prep and look into them and what have you too, to be able to answer them as accurately as we can. You send them to asktom@talkmoneywithtom.com. Of course, you can subscribe to our channel and hit the little bell button if you want to get notified. I put out a video every day when the market's open, talking about short video, 2 minutes or so, 3 minutes, about what I saw happening in the market that day. I think that's very educational. And then, of course, if you want to, you can just meet with Ethan and I. We have our schedule is online. You can go to the website, hit the book appointment button that's up in the corner, and pick out a time that works for you. So be happy to talk with you also. So that's our show for today. I want to thank everybody so much for coming, and I look forward to seeing you again next week.